A common question I get from stock market investors is which dividend ETFs or dividend-paying stocks would they recommend? And also, does it make sense to focus on dividend-paying stocks? In this video, I'm going to debunk the dividend preference myth and explain to you why it actually doesn't make sense to have a bias towards dividend-paying stocks. We're going to look at how does compounding work if there are no dividends to be reinvested, and we're going to compare the performance of two ETFs. I'm going to show you how to analyze total returns, where you include dividends and growth of stocks, because there are basically two components to returns in any stock. The first is the dividends that they pay, and this would be the profits that the company makes, and they decide to pay out a portion of that as dividends to the shareholders. And the second portion is the capital growth of a stock, and that relates to the value of the company and how it grows over time. If a company makes a profit and they decide not to pay that profit out as a dividend to the shareholders, it could be reinvested in the company, and it can help the company grow and expand. But the point is, profits can either be paid out as dividends or it could be held to increase the value of the company. So this dividend debate is actually nothing new. There was already an academic research paper published in 1961 by Miller and Modigliani, which debunked the myth that dividend-paying stocks should be preferred. To summarize their research, the market value of a firm depends on its earning power and investment policy, not how profits are distributed as dividends or retained earnings. It also says investors can create homemade dividends by selling a portion of their shares if they prefer to have cash. And this makes dividend payouts irrelevant. What does this mean in layman's terms? If we look at this graphic, this company has a value of 10 million. It makes a profit of 1 million after tax. It has two options. Option one would be paying out that 1 million of profit as dividends to its investors. Option two would mean keeping that 1 million in the company as retained earnings and not paying it out. How would this impact the shareholders? Option one, the shareholders would sit on a value of 11 million. We're ignoring the impact of dividends tax for now. The value of their shares in the company would be worth 10 million, but then also they would have 1 million of cash because of the dividends that was paid out to them. In option two, if that 1 million of profits was kept as retained earnings in the company, the value of the company would increase by 1 million because they would be holding that profits on their balance sheet as retained earnings. So then the value of the company in the eyes of the shareholders would increase to 11 million. The basic principle to understand here is that that 1 million of profit could either be paid out to shareholders as dividends, which increases the cash that the shareholders have, or it could be retained within the company, then it increases the value of that company with 1 million. In both scenarios, the value in the hands of the investors are the same. But of course, we need to consider the impact of tax because there are two tax implications in this scenario. And of course, this would be dependent on where you live and on where the company that you're invested in is located. But broadly, there is dividends tax implications once profits are paid out as dividends to investors. And also, there will be capital gains tax payable when shares are sold. And the capital gains tax is calculated as a percentage on the gain, which is the difference between what you paid for the share and what you sold it for. In both scenarios, there are tax implications to consider. If you think about it this way, companies that pay regular dividends are potentially creating some tax inefficiencies. If their shareholders prefer to have cash, they would probably be better off to sell off some of the value of their shares and realize it as a capital gain, because typically capital gains tax is lower than dividends tax. And capital gains tax would only be incurred when a sale happens, where dividends tax is then applicable every time dividends are paid out, which could be annually or even more often. If you're enjoying this video, please subscribe to my channel. If you want to learn how to be a smart stock market investor without being a financial expert, sign up to my investing course. You can find all the details in the caption. Let's look at this infographic to explain exactly what I mean with the inefficiencies that could be created with dividends tax. This company again has a value of 10 million and it makes a profit of 1 million after tax. Option one would mean paying out the 1 million as a dividend to investors. Let's assume dividends are taxed at 20% in the hands of investors. If the full 1 million is paid out as a dividend, there would be 200,000 of tax payable on that. So the investor would only get 800,000 of cash in their pockets. In this case, the value that they would have associated with these shares is 10 million of value in shares and 800,000 of dividends that was paid out in cash. If this investor wants to buy more shares in the company, they could take this 800,000 and put it back in the company, but then they would only have 10.8 million of value. In option 2, if the company decides to hold this 1 million as retained earnings, the value of the shares in the eyes of the investor would be 11 million. And only once they decide to sell off some shares when they have a need for cash would the capital gains tax be payable. So on the one side, when dividends are paid out regularly, they always attract tax, which creates that inefficiency. If dividends are reinvested, assuming that the company has capacity to put that money to work within the company and add value to shareholders, then there wouldn't be any inefficiency created by distributing profits to shareholders, which attracts the dividends tax. A few more things to think of when it comes to tax. Dividends tax implications would depend on your country of residence and also where the company or fund is located, and also that foreign dividends could be taxed at a different rate than local dividends if you're investing in foreign companies. But in most cases, if you have a need for cash as an investor, you would be better off selling off some shares and paying a capital gains tax rather than investing in stocks that pay regular dividends because of the inefficiency that the dividends tax creates. How does this look in the stock market? Here is an infographic to explain. Company 1 is a dividend-paying company and company 2 doesn't pay any dividends. Let's imagine company 1 has a share price of $10 a share and the earnings per share is $2. It then pays out a dividend of $2 and the share price would go back to $10 once the dividend is paid. For now, we're ignoring the signaling effect of dividends, which is something I'll touch on a bit later. The shareholder would have a share of $10 and it would have cash of $2, ignoring the dividends tax for now. Company 2, which doesn't pay any dividends, also has a share price of $10 and earnings per share of $2, but it doesn't pay out any dividends. So the earnings are retained in the company as retained earnings on the balance sheet. In this case, the shares of company 2 would increase to $12 per share. In both cases, the shareholders have a value of $12. The one has $10 of shares plus a $2 dividend, and the other one has $12 worth of shares. So what does homemade dividends mean? This basically means that it could make more sense for you to control liquidation according to your cash flow needs and not be at the mercy of stocks and when they decide to pay out dividends, but rather deciding according to your cash flow needs when you sell off some shares. This also avoids value destruction caused by dividends that are paid out. So this infographic explains homemade dividends. It's the same company 1 and 2 as before, except now we're considering the dividends tax. In option 1, we're assuming 20% dividends tax on the $2 dividend that's paid out. So this investor in option 1 would have shares of $10, but also cash of $1.60. The investor has $11.60 of value. So let's assume the shareholder in company 2, which doesn't pay any dividends, has a need for cash flow, and in this case realizes the $2 growth in value by selling off some of his shares. The capital gains tax would obviously depend on the base cost paid for the shares, but let's assume that 50% of the value of the sale is subject to capital gains tax. In this case, the $2 sale would have a $1 capital gain, which is then taxable at, let's assume again, a 20% tax rate. So that would mean that only $1 would be subject to 20% tax, and that is a 20-cent capital gains tax payable. Once this investor has sold off this $2 of shares, they would still have $10 worth of shares in the company, but also an additional $1.80 of cash after selling off shares and paying 20 cents of capital gains tax. In this scenario, the investor would be better off holding shares and selling them off as a need for cash arises and then paying capital gains tax. So you may be thinking that a company that is able to pay out dividends and has a high dividend yield must be healthier, has better cash flows, and is better at generating profits. But the research shows us, in fact, that is not true. And here is 2 examples to prove it. I looked for a high dividend ETF. On this list, I chose the top one, the Invesco KWB Premium Yield Equity ETF, which has a dividend yield of 7.84%. And I'm comparing this to a simple S&P 500 ETF. The long-term dividend yield of the S&P 500 is between 2 and 3%. So in this case, this ETF has a dividend yield of more than 2 times of an S&P 500 ETF. Let's compare a $10,000 investment in both of these ETFs. To be able to compare apples to apples, we're going to reinvest dividends on both sides to Ensure that the cash flows that are generated by the high dividend yield ETF is also taken into consideration to see what the compounding effect thereof would be. If you invested $10,000 in both of these ETFs in 2011, your investment in the high yield dividend ETF would be worth $19,700, and your investment in the S&P 500 would be worth $61,000. This value takes into consideration the cash flows from dividends, because we assume that that's reinvested. You would have been much better off investing in an S&P 500 ETF rather than having a preference for a high dividend yield ETF. In fact, you would be $40,000 better off, which is a massive difference. And in the worst year, the dividend ETF actually lost more value than an S&P 500 ETF, which is contrary to what most people think, because a lot of people mistakenly prefer dividend-paying stock, assuming that they would perform better during a stock market downturn. So how can you compare the returns of two ETFs? Because you want to take into account the dividend yield, but also the capital growth of the stocks. The way to do this is to look at the total return, which is usually disclosed on the fund fact sheets. You can easily find that data online for single stocks. But as you know, I'm not big on stock picking, so I'm going to explain to you how to compare the returns of these two ETFs used in the example. Usually the fund fact sheets disclose the annualized return, which considers both the return generated due to the growth in value of the ETF, but also due to the dividends paid out by the underlying stocks in the ETF. If we just look at the 10-year annualized return in this case, you will see that the S&P 500 ETFs performed significantly better than the high dividend yield ETF. So what are potential criticisms to what I've explained in this video? There are tax implications to consider, and this could depend on where you are based as an investor and where the companies or ETFs that you're invested in are domiciled. The other thing is the signaling effect. Dividends can signal good financial health, which in turn influences stock prices. But there are many successful companies that have paid off massively if you had invested in them, despite them not paying dividends. There is also a behavioral factor to consider, is that some investors prefer regular dividends from their stocks. But in my opinion, you as an investor should be after the highest total return, and then you could liquidate shares as your cash flow needs arise. I've also linked some more academic papers if you want to read up on why it doesn't make sense to have a preference towards high dividend yield stocks or ETFs. Total return should be your deciding factor.